A lot of people assume loan recasting and refinancing are basically the same thing. They're not. They both can lower your monthly mortgage payment, but they work in completely different ways. Let's start with refinancing because that's the one most people have heard of. When you refinance your mortgage, you are replacing your existing loan with a brand new loan. That means new paperwork, a new interest rate, potentially a new loan term, and closing costs. Your old mortgage is paid off and a new one takes its place. If interest rates have dropped since you took out your original loan, refinancing can reduce your rate and save you money over time. You might also refinance to shorten your loan from 30 years to 15 years or extend it to lower your payment. Refinancing is essentially a reset. Now let's compare that to loan recasting. Loan recasting does not replace your mortgage. You keep your original loan, your original interest rate, and your original remaining term. Instead, you make a large lump sum payment toward your principal, and then your lender recalculates your monthly payment based on the new lower balance. And that's it. No new loan, no new rate, no major closing costs, just a recalculated payment. Here's where the difference becomes clear. Refinancing changes the structure of your loan. Recasting changes the math of your existing loan. Refinancing can lower your interest rate. Recasting cannot. Refinancing typically involves thousands of dollars in closing costs. Recasting usually involves a small administrative fee, often just a few $100s. Refinancing restarts the clock. If you refinance into a new 30-year loan, you may extend how long you're paying interest. Recasting keeps you on your original payoff timeline. Now, let's talk strategy because this is where nuance matters. If interest rates are significantly lower than when you took out your mortgage, refinancing may provide the biggest long-term savings because you're reducing the rate itself. But if you already have a very low interest rate and don't want to lose it, recasting can be attractive. You can lower your monthly payment by reducing principal without giving up your favorable rate. Recasting is often used when someone receives a windfall, like selling another property, getting a bonus, or receiving an inheritance. They apply that lump sum to the mortgage, then recast to improve monthly cash flow. But there's a trade-off in both cases. With refinancing, you're paying fees and potentially extending your timeline. With recasting, you're tying up a large amount of cash in home equity, which reduces liquidity. In simple terms, refinancing is like trading in your mortgage for a new one. Recasting is like paying down your existing mortgage and asking the bank to recalculate the payment. They can both lower what you owe each month, but they solve different problems. And understanding which tool fits your situation depends on one big question. Are you trying to lower your interest rate, or are you trying to lower your required payment without changing your loan? That distinction makes all the difference.